The global financial system has entered a phase that many institutional analysts once believed would arrive much later in the decade. Yet a growing number of senior market observers now argue that the transition has already begun beneath the surface of the public narrative. Inside policy circles, discussions surrounding sovereign debt sustainability, persistent inflationary pressure, and declining confidence in fiat purchasing power have intensified with unusual urgency, creating the exact environment in which precious metals historically begin to outperform traditional financial assets. According to several former monetary insiders and macroeconomic strategists with long-standing connections to central banking networks, silver is no longer being viewed merely as an industrial commodity or speculative metal. Instead, it is increasingly being recognized as a strategic monetary asset positioned to benefit from systemic instability, aggressive currency debasement, and accelerating demand from advanced technological industries. The significance of this shift cannot be overstated, because the majority of retail investors still perceive silver through an outdated framework tied primarily to jewelry demand or cyclical commodity trends, while institutional participants are quietly reassessing silver's role in a world where debt burdens are spiraling beyond manageable levels. Over the last several years, central banks across the world have expanded balance sheets at historic rates, injecting trillions of dollars into financial markets in an attempt to stabilize economic growth and prevent systemic contraction. Now, while these measures temporarily supported liquidity, they also created structural distortions that continue to pressure currencies and sovereign bond markets. The result is a growing recognition among elite financial circles that the era of easy monetary credibility may be nearing its limits. A former Federal Reserve consultant recently described the situation as a confidence balancing act, explaining that central banks can maintain public trust only as long as inflation remains politically manageable and bond markets continue functioning without severe disruptions. Once confidence begins deteriorating, hard assets traditionally absorb capital flows at extraordinary speed. Gold typically attracts early institutional positioning, but silver historically follows, with far greater percentage gains because of its comparatively smaller market size and tighter physical supply conditions. What makes the current environment especially significant is the convergence of monetary demand and industrial demand occurring simultaneously. Unlike previous silver rallies, driven mainly by inflation fears or speculative enthusiasm, today's market dynamics are supported by structural industrial consumption tied directly to the global transition toward electrification, renewable energy infrastructure, and advanced semiconductor manufacturing. Silver remains an essential component in solar panels, electric vehicles, high-performance batteries, medical technologies, and military-grade electronics because of its unmatched conductive properties. Industrial demand has therefore become increasingly inelastic, meaning manufacturers cannot easily substitute alternative materials without sacrificing efficiency or reliability. This creates a rare market condition where investment demand and industrial necessity compete for the same limited supply base. Several commodity analysts have highlighted an increasingly alarming imbalance developing within the physical silver market. Mining production growth has failed to keep pace with rising demand despite elevated commodity prices and growing geopolitical incentives to secure strategic mineral reserves. Many major silver deposits are byproducts of copper, zinc, or lead mining operations, meaning silver supply cannot rapidly expand unless broader industrial mining activity also accelerates. Meanwhile, environmental regulations, declining ore grades, and rising extraction costs continue constraining production capacity across major mining regions. Institutional buyers understand that these supply limitations create the foundation for violent price repricing once broader investor participation intensifies. The comparison many analysts now draw is not with ordinary commodity cycles, but with historical monetary dislocations, where asset revaluation occurred abruptly after long periods of suppression. Throughout history, silver has demonstrated a tendency to remain undervalued for extended durations before suddenly experiencing explosive upward repricing once investor psychology shifts. During inflationary crises, debt scares, or currency confidence collapses, silver often transitions from ignored asset to panic acquisition vehicle within remarkably short timeframes. This behavioral pattern is precisely why some insiders believe a move toward $150 silver could unfold far faster than conventional forecasts suggest. Institutional accumulation patterns have also become increasingly difficult to ignore. Physical bullion withdrawals from major exchanges, rising sovereign interest in precious metal reserves, and unusual options activity in futures markets all suggest that larger participants may already be positioning for significant upside volatility, while mainstream financial commentary continues emphasizing short-term interest rate expectations and temporary economic indicators. Deeper structural pressures remain unresolved. Sovereign debt levels continue expanding at rates that exceed sustainable economic growth, while governments increasingly rely on monetary accommodation to stabilize fiscal conditions. Such policies may postpone crisis conditions temporarily, but they also reinforce long-term inflationary dynamics that favor scarce hard assets. Another critical factor driving bullish expectations for silver involves declining confidence in traditional portfolio diversification strategies. For decades, investors relied on bonds to offset equity market volatility, yet rising inflation and unstable rate environments have weakened that relationship considerably. As institutional investors search for alternative hedging mechanisms capable of preserving purchasing power, precious metals are regaining strategic relevance within diversified portfolios. Silver, because of its dual monetary and industrial nature, occupies a unique position capable of benefiting from both defensive capital flows and economic transformation trends. Market psychology may ultimately become the catalyst that accelerates silver's trajectory toward triple-digit territory. Financial markets operate not only on fundamentals, but also on collective perception and momentum. Once investors begin recognizing that supply deficits cannot easily be resolved and monetary instability continues intensifying, capital inflows into silver could expand dramatically. Since the silver market remains relatively small compared with global equity and bond markets, even modest reallocations from institutional capital pools could produce disproportionately large price movements. This is precisely why experienced insiders warn that waiting for mainstream confirmation may prove costly. By the time financial headlines openly acknowledge silver's structural bullish setup, much of the explosive revaluation could already be underway. Behind closed doors within major financial institutions, the conversation surrounding silver has evolved from speculative curiosity into serious strategic analysis. Several macroeconomic research desks that previously devoted minimal attention to precious metals are now publishing increasingly aggressive long-term projections, citing a combination of fiscal instability, industrial scarcity, and geopolitical fragmentation as the primary catalysts for future price acceleration. What distinguishes the current outlook from previous commodity enthusiasm is the breadth of forces converging simultaneously across multiple sectors of the global economy. Silver is no longer benefiting from a single narrative. Instead, it is positioned at the intersection of monetary distrust, technological expansion, energy transformation, and resource nationalism, creating a setup that many veteran analysts consider historically rare. One of the most important developments influencing institutional sentiment involves the changing relationship between governments and financial markets. For decades, central banks maintained the perception that inflation could be managed through interest rate adjustments and liquidity interventions. However, the post-pandemic era revealed structural vulnerabilities that traditional policy tools have struggled to contain. Persistent inflationary pressure, despite aggressive tightening campaigns, exposed how deeply dependent modern economies have become on debt-fueled growth and monetary stimulus. This realization has profoundly altered the way sophisticated investors assess long-term currency stability. Former monetary officials have repeatedly warned that advanced economies are approaching a point where debt servicing costs could become politically and economically destabilizing. Governments facing enormous fiscal deficits cannot tolerate prolonged periods of elevated interest rates without risking recessionary contraction, banking stress, and sovereign financing difficulties. Consequently, many insiders believe central banks will eventually return to accommodative policies even if inflation remains structurally elevated. Such an outcome would significantly weaken real purchasing power while simultaneously strengthening the investment case for tangible assets with limited supply. Silver stands among the most compelling beneficiaries because it combines monetary sensitivity with indispensable industrial utility. The industrial dimension of silver demand deserves particular attention because it fundamentally separates the current market cycle from historical precedents. Global electrification initiatives require vast quantities of silver for energy transmission systems, photovoltaic technology, advanced circuitry, and battery infrastructure. Governments across North America, Europe, and Asia continue committing trillions of dollars toward renewable energy expansion and technological modernization, yet few policymakers openly address the raw material constraints underlying these ambitions. Solar energy alone consumes substantial quantities of silver annually, and demand projections continue rising as countries accelerate decarbonization strategies. Electric vehicle manufacturing further intensifies consumption because modern vehicles require significantly more silver than conventional combustion engine designs. Meanwhile, the physical supply landscape continues deteriorating beneath the surface. Exploration spending within the mining sector has not generated enough high-quality discoveries to offset long-term depletion trends. Many producing regions face political instability, regulatory uncertainty, labor disruptions, and escalating operational costs that reduce profitability and discourage aggressive expansion. Additionally, because silver production often depends on the economics of base metal mining operations, Supply growth cannot easily respond to rising silver prices alone. This creates an exceptionally fragile equilibrium where demand increases collide with constrained production capacity. Several commodity strategists have also highlighted the growing disconnect between paper-silver markets and available physical inventories. Futures contracts and derivative instruments create the appearance of abundant liquidity, yet physical delivery data suggests underlying tightness is becoming more pronounced. Institutional buyers increasingly prefer direct ownership and allocated storage rather than relying solely on paper exposure, signaling concerns regarding future availability. Historically, such transitions from synthetic positioning toward physical accumulation have preceded major commodity repricing events. Geopolitical tensions further strengthen the bullish thesis surrounding silver. The global economy is fragmenting into competing strategic blocks as nations prioritize supply chain security, domestic manufacturing resilience, and resource independence. Precious metals are becoming increasingly important within this environment because they function as universally recognized stores of value outside traditional currency systems. Several countries have expanded gold acquisitions aggressively over recent years, and some analysts believe silver may eventually experience a similar institutional accumulation phase due to its relative affordability and industrial significance. Investor psychology also appears to be approaching a critical inflection point. For years, speculative capital concentrated heavily within technology equities, cryptocurrencies, and high-growth financial assets supported by ultra-low interest rates and abundant liquidity. However, volatility within these sectors has encouraged a gradual reassessment of risk exposure. Wealth preservation strategies are regaining prominence among institutional allocators, seeking protection against monetary debasement and financial instability. Precious metals, therefore, occupy an increasingly attractive position within portfolio construction models designed for uncertain macroeconomic conditions. The possibility of silver reaching $150 sooner than expected no longer appears confined to fringe speculation. Multiple scenario analyses conducted by independent research firms demonstrate that relatively modest shifts in investment allocation could trigger substantial upward repricing because of the market's limited size and constrained inventories. If pension funds, sovereign wealth funds, and large institutional investors allocate even a small percentage of capital towards silver exposure, available supply could tighten dramatically. Such an environment would likely generate momentum-driven buying behavior capable of accelerating prices beyond conventional expectations. Importantly, silver's historical volatility works in both directions. During periods of pessimism, prices can remain suppressed for extended durations despite improving fundamentals. Yet once sentiment reverses and momentum develops, silver frequently experiences explosive upside movements within compressed timeframes. Previous bull markets demonstrated how quickly investor demand can overwhelm available supply, leading to parabolic price advances that surprise even experienced analysts. This is why many insiders emphasize preparedness rather than prediction. The precise timing of major market revaluation events remains impossible to forecast with certainty, but the underlying structural conditions supporting higher silver prices continue strengthening. Monetary instability, industrial dependence, constrained supply growth, and shifting investor psychology collectively create an environment unlike anything witnessed in previous decades. In the view of numerous seasoned financial professionals, silver may not merely participate in the next global commodity supercycle. It could emerge as one of its defining assets. As financial markets move deeper into an era defined by sovereign debt expansion, geopolitical rivalry, and declining monetary confidence, the strategic importance of silver is becoming increasingly difficult for institutional investors to ignore. The narrative surrounding silver has evolved far beyond traditional commodity speculation, because the metal now sits at the crossroads of two powerful global transformations: the restructuring of the monetary system and the acceleration of technological industrialization. Veteran analysts who previously maintained conservative long-term projections are beginning to reassess valuation frameworks entirely, arguing that conventional pricing models fail to account for the magnitude of structural pressures building beneath the surface of the global economy. One of the central reasons insiders believe silver could advance toward $150 sooner than expected involves the growing realization that inflation is no longer a temporary phenomenon tied exclusively to post-pandemic disruptions. Instead, inflation increasingly appears embedded within the architecture of the modern financial system itself. Decades of debt accumulation, persistent deficit spending, and dependence on monetary intervention have created conditions where policymakers possess limited flexibility. Governments require ongoing liquidity support to sustain economic activity and stabilize financial markets, yet continuous monetary expansion steadily erodes currency purchasing power over time. This dynamic creates a favorable environment for scarce, tangible assets capable of preserving value outside the traditional banking structure. Historically, periods of declining confidence in fiat systems have driven extraordinary capital flows into precious metals. Gold typically functions as the initial defensive asset because of its long-standing role as a monetary reserve, but silver often follows with significantly greater percentage appreciation due to its smaller market capitalization and heightened sensitivity to demand surges. Analysts studying previous inflationary cycles note that silver has repeatedly demonstrated the ability to outperform expectations once investor participation broadens beyond niche commodity circles. The combination of accessibility, affordability, and strategic utility allows silver to attract both institutional capital and retail momentum simultaneously during periods of financial uncertainty. What distinguishes the present environment from prior precious metal cycles is the unprecedented scale of industrial dependency now linked directly to silver consumption. Advanced economies are pursuing ambitious infrastructure transitions centered around electrification, renewable energy deployment, artificial intelligence systems, telecommunications expansion, and defense modernization. Silver remains indispensable across these industries because of its exceptional conductivity, antimicrobial properties, and reliability within high-performance applications. The challenge facing manufacturers is that demand growth continues accelerating, while the pipeline for major new supply discoveries remains insufficient. Mining executives have repeatedly acknowledged that bringing significant new production online requires enormous capital investment, extensive permitting processes, and many years of operational development. Environmental regulations and geopolitical tensions further complicate expansion efforts in key resource regions. Consequently, the silver market cannot rapidly respond to sharp increases in demand. This supply rigidity becomes especially dangerous when combined with growing investment interest, because relatively small shifts in capital allocation can produce dramatic pricing consequences within tightly constrained markets. Several former institutional traders have described silver as one of the few remaining markets where pricing inefficiencies may still exist on a meaningful scale. They argue that years of speculative short positioning, derivative dominance, and limited mainstream attention suppressed silver's valuation relative to both inflation-adjusted historical highs and broader commodity performance. If market participants begin reassessing silver based on physical scarcity rather than purely financial trading dynamics, price discovery could occur at levels far above current consensus forecasts. Another factor accelerating bullish expectations involves the weakening credibility of traditional safe haven assets. Government bonds historically provided stability during economic downturns, but elevated debt burdens and inflationary risks have undermined confidence in long-duration sovereign securities. At the same time, equity valuations in several sectors remain heavily dependent on continued liquidity support and optimistic growth assumptions. This has encouraged institutional allocators to reconsider the role of hard assets within diversified portfolios. Silver's dual exposure to monetary protection and industrial growth positions it uniquely within this transition. The psychology of financial markets often changes gradually before shifting suddenly. For extended periods, investors dismiss emerging trends because prevailing narratives remain deeply entrenched. Yet once perception changes and momentum accelerates, repricing can unfold with astonishing speed. Silver's relatively small market size amplifies this phenomenon because it cannot absorb massive capital inflows without substantial volatility. A coordinated wave of institutional accumulation combined with rising retail participation could therefore propel prices upward far faster than conventional models anticipate. Some analysts compare the current setup to historical moments when markets underestimated structural imbalances until confidence abruptly collapsed. In such environments, assets previously viewed as secondary or speculative transformed rapidly into primary stores of value. Silver's accessibility gives it a unique advantage during these transitions because it appeals across multiple economic classes and geographic regions simultaneously, from sovereign entities seeking reserve diversification to individual investors. Pursuing wealth preservation, the potential buyer base remains extraordinarily broad. Importantly, the prospect of silver reaching $150 should not be interpreted merely as a prediction of speculative mania. Many insiders view such pricing as a reflection of deeper systemic realities involving currency dilution, industrial scarcity, and declining trust in traditional financial mechanisms. If governments continue prioritizing monetary expansion to manage debt burdens and stabilize economies, precious metals may experience sustained repricing rather than temporary cyclical rallies. Ultimately, the significance of the current silver thesis extends beyond the metal itself. It reflects a broader transformation occurring within the global financial order. Markets are entering a period where tangible scarcity, monetary credibility, and strategic resource control may become more influential than conventional valuation metrics driven solely by liquidity conditions. In that environment, silver occupies a uniquely powerful position. According to numerous seasoned financial insiders, the question is no longer whether silver possesses the potential for dramatic appreciation, The real question is whether investors will recognize the scale of the opportunity before the market reprices faster than expected.